Well, hey there, everyone. Happy Friday, August 1st, first trading day in August. Not a great day for stocks. We'll get to that in a minute. I'm Dave Keller here with Market Misbehavior, coming to you from a beautifully sunny and comfortably warm, but not so hot Redmond, Washington. This is the time of the year when it's a really cool place to live because the days are very long. The sky is clear. Everything's pretty green. It doesn't get too hot or humid, so we'll take it. There's rain other times of the year where it's sort of balances out, but this is a pretty comfortable time. Hope you guys are all doing well wherever you're at. We're recording this a little bit early, about an hour before the market closed on Friday. So far it's been a pretty rough day. To be clear, as you probably have noticed, for risk assets, we'll see what happens in the last hour of trading. But as of now, the major average is down fairly significantly. The S&P having one of the worst days we've seen in a while here. And this comes after the latest economic data, very much not as strong as possible, particularly the jobs data. And what was more interesting to me, by the way, is that the last 2 months were actually downgraded significantly as well. So it's almost laughable as I'm reading this article, and it just sort of explains it very factually. I'm just like, this is crazy. So non-farm payrolls, this is from CNBC that I'm quoting, expanded 73,000 last month, which was less than 100,000, right? So under, still more, but a lot, less than expected. But this is the really interesting one. June job growth had been reported as up 147,000, and the revised number is up only 14,000. That is a huge difference. The May count was at 125,000 and was now revised much lower to 19,000. So I think the story here, if you read below the headline is, jobs came in less than expected. But the story is that the last 2 monthly reports were completely revised downwards. If you think technical analysis has some questionable data issues, man, economics is like a moving target, right? We're restating two months ago. Arguably, it's so funny. It's like, as technical analysis, as much as it's been, critiqued over the years by many fundamentally oriented investors and economists, you often restate economic data from months and or quarters past. You often restate fundamental data when companies have to revise their earlier, numbers. You don't restate price, as one of my mentors, Ralph Eckenpour, always used to say. Price is fact. We don't restate that down the road. Having said that, let's do a little market recap here. So on Friday, what we like to do is do a brief market recap. Then we'll answer some questions that we received from all of you through the course of this week. Thank you, as always, those of you tuning in on the live stream. If you're doing so, I really appreciate it. Drop questions anytime. I'm always looking to see what you guys are asking about. Helps me to, sort of shape the content going forward. And if you're watching this on our YouTube channel, just put a comment below the video with any questions that come up as you're watching the show. Appreciate your questions. Appreciate your feedback for sure. And we'll get to it. So brief market recap here. And again, this is as of around 3 p.m. Eastern as we're doing the show. At this point, the S&P looks to be down about 1.6%. The NASDAQ Composite down 2.25%. The VIX pushing almost 4 points higher above 20. We'll see what happens in the last hour of trading. That's often where a lot of volume gets injected into the markets. However, I would just remind you, VIX over 20 is no longer a low volatility environment. And what's happening today is we've been talking about that balance between the trends still remaining quite strong. We made new all-time highs just earlier this week, but signs of weakness internal, right? We're seeing internal weakness, things like breadth conditions looking less good, particularly short-term breadth readings. As we'll talk about, certainly with our Market Misbehavior Premium members over the weekend with our weekly flight plan, which is our main report for our premium members. We'll have to go through in detail a lot of the updated data that was circulated here on Thursday into Friday, and what this sell-off on Friday could mean for risk assets going forward. But certainly today, seeing weaker breadth continued. We're seeing weaker momentum. We're seeing weaker trend all of a sudden as some key short-term levels appear to be breaking today. And again, that, it's barring a huge rally in the last hour of trading. But VIX over 20, certainly something I'll be looking for. Dollar really not part of the picture here today, sort of weakening today, but bond price is definitely going up. So you have stocks weaker and bonds stronger. We had a market misbehavior podcast interview earlier this week, just released this morning with Callum Thomas of Top Down Charts. He made the argument that the Fed should actually be considered raising rates as opposed to lowering rates, and explained his justification for it. But one of the things we talked about in great deal was the stock to bond ratio. He saw that as a key area of focus in his work, and I'll let him in the episode explain more about his particular takeaways. But today we're seeing a bit of a rotation from stocks into bonds, rates generally moving lower, with the 10-year yield now back below 4.25%. Looking at the commodity space, some safe havens like gold actually rallying today. The GLD up 1.8%. Silver, copper prices up as well. Crude oil down, and a lot of commodities actually down today. Cryptocurrencies like Bitcoin rotating lower along with equities today. Bitcoin currently trading just below 114,000. Yesterday, we were up in the 118,000, 119,000 range. So it's been a bit of a haircut today, and all 10 of the top coins on stock charts in the red. Looking at the sectors, only 3 of the S&P sectors in the green here with an hour remaining on the first trading day in August. Healthcare, consumer staples, utilities, the only 3 in the positive. REITs, slightly negative. So your top 4 sectors are the 4 defensive sectors. One of the things we've talked about, one of those red flag charts we look for, is the relative performance of defensive sectors. And it looks like those are continuing to improve here. On the downside, you have consumer discretionary, Amazon dropping pretty significantly after missing earnings yesterday. That's down 2.6% for the XLY. Technology, the XLK, down 2.2%. We had Meta and Microsoft earlier this week, and Apple yesterday. Some of those stocks that gapped higher on earnings actually trading lower after that gap, and I think that's concerning. Tech, in the form of the XLK, down 2.25%. Financials and energy both down about 2%. Something, again, we'll update with our market misbehavior premium members this weekend will be our market trend model. As of Thursday's close, look like mid caps and small caps could turn negative on their short-term reading. If the market closed at current levels today, the short-term model for the S&P 500, which is our main model, would turn negative. That market trend model has been bullish on all time frames since the beginning of May. So this would be a pretty significant change if that would happen. Breadth continues to be negative most days this week. The breadth has been pretty bad. Breadth in small caps the worst, 85% down, only 14% of the S&P higher. Not quite as bad, but still pretty much in the red for the New York Composite Index. All 7 of the Magnificent 7 stocks and friends down here as we get into the last hour of trading. Amazon currently trading over 8% below Thursday's close. So big miss from a big online retailer. Meta, after having a fantastic report and a strong upswing post-earnings on Wednesday, Thursday pretty strong, Friday down 3.3%. Netflix, the best performer, still down about 0.25% here, again, going into the last hour of trading. Again, we'll go into this in a lot more detail, and if you want, if you want help, if you want, someone navigating these markets a little more closely with you, encouraging you and mentoring you through what could be a challenging August and September, think about our market misbehavior premium memberships. You can find more info at marketmisbehavior.com/premium. We have an online members-only community where you can ask questions, sort of like what we do on the show, but every question is answered. All of my premium members get a lot of attention. And that's by design. The idea is to work a little more closely with a smaller group of motivated investors to help them upgrade their processes. And I've found market uptrends are when it's very easy to ignore things like routines and risk management and stuff like that. All the bad habits, kind of, you can get away with them because markets are going up. Markets start going down, bad habits start to be pretty painful and start to cost you money in your portfolio. So check it out at marketmisbehavior.com/premium. Use the code YouTube when you check out for 30% off your first 12 months on any plan. But think about that if you need help navigating whatever this is going to end up being over the next 6 to 8 weeks. Could be a challenging phase here. So the S&P appears to be going below its 21-day EMA. If we would close below there, that's the first time we've closed below there since mid-April. Breadth conditions rotating lower. I'm noting that now less than 50% of the S&P members are above their 50-day moving average. We'll see where we close. But again, breadth the data rotating more weak. It's going to be an interesting stretch here for sure. All right, let's get to the questions. As a reminder, one of the great benefits of the show, or I hope one of the purposes of the show, is to see what questions come up and to answer questions along the way. My goal is to help you guys navigate these markets in some large or small way, and I hope you find that the content in our discussion empowers you to do so. Here are some of the questions we received this week that we didn't have a chance to get to, but I think are worth going through. Question one is the Dow Jones forming a triple top at 45,000? That's a fantastic question. You know what? I mean, one chart I don't look at a ton is the Dow Jones Industrial Average, and I tell you the reason why I don't is because between the S&P and the Nasdaq and the Dow is a distant third in terms of value for looking at an index. I do think where the Dow 30 is quite helpful is looking at the members of the Dow, because those 30 stocks are a pretty decent cross section of technology, consumer, industrials, growth, value, offense, defense. The Dow kind of has a little of everything. It's not a comprehensive index. That's something like the S&P is much better at sort of giving the conditions of the overall market. But if you want a working list of pretty important stocks to understand and analyze, the Dow is actually a pretty good group of 30 stocks. A little energy, little financials, little tech, little everything. Having said that, is this a triple top? It could be, right? And I would say up until today's drop, it's still very much a question mark. I would argue at this point, kind of definitely looks like one. Now, having said that, I mean, triple top pattern's not the most meaningful pattern out there. I mean, calling it a triple top pattern, I guess you certainly could. I don't want to say that's not something you can do, but a double top pattern, which is basically we set a peak, and then we pull back and retest it and then roll over. A double top pattern is pretty important. And we saw that in February. While the S&P and the Nasdaq made new highs, the Dow is actually retesting its high from Thanksgiving and then rotated lower. So that's actually a pretty concerning topping pattern. Do you call this a triple top? I mean, technically you probably would. I mean, for me, it's just retesting that resistance from November and from January. 45,000 is the ceiling, right? And we learned that first around Thanksgiving. We really confirmed that in early January. And that's why when you have a big V-shaped recovery like this, I always look to the left and focus on those previous all-time highs. So whether you call it a triple top or not, I probably wouldn't label it a triple top pattern, because for me, that implies more like 1, 2, 3 kind of right in succession would be more of a triple top. This is sort of like this big gap between the two. So I think it's a different thing, I would say. But is it a retest of a very important, if not the resistance level? 100% it is. Would I expect resistance at 45K? I would. Am I surprised we're getting a pullback from that level? I am not surprised at all. So there's an answer to your question. Probably wouldn't label it a triple top. Is it a meaningful level of resistance that I think the market is struggling with and would continue to struggle with getting above? I definitely would. Next question. Can a slowed stochastics S&P 500 divergence be used to confirm an RSI divergence? I think I get what you're looking at. You're basically saying, look, trying to think of where there might be a good divergence. I feel like I should have these sort of things readily available. And I should. Boy, this is one I probably should have prepared ahead of time. I'm trying to find a good, I tell you what, like the IWM, right? It's having a divergence here. All right, so here's the IWM making higher highs in price on weaker momentum in July. And your question is, can we use slow stochastics, I see, to confirm that? So here's a pretty clear divergence, right? Higher highs in price, lower peaks of momentum. Let's switch this bottom. I mean, the short answer is you could. But the real answer is, would you want to, I guess, right? Could you use this and say this is also a divergence? I mean, I think you could. Could you use something like MACD and use that to confirm these divergences as well? I guess you could, right? I mean, there's no reason why you can't do that. It's less can you do? Yes, you can. Does that help, right? Does it really add value to confirm it? I don't think so. I mean, my initial response is no. I watch for RSI divergences all the time. I rarely look for divergences, nor do I use the stochastics indicator very often, only because for me, RSI is kind of the way that I measure momentum. I don't need another way to measure momentum. I feel like I got that covered. Would you note divergences in something like MACD, which is a little more of a trend following indicator? I mean, maybe. For me, RSI is kind of the main tool I use for divergences. I usually don't try to confirm that with other divergences. When I see an RSI divergence, I then start to think, okay, what would happen in price for me to validate that, yeah, that divergence was really a great leading indicator and we're starting to see distribution, right? So when I see the RSI divergence, I put it on this mental list or sometimes in an actual chart list on stock charts and say, here's some things showing a potential divergence. These are the things on breakdown watch. These are things that might be breaking down. And I want to clearly set an alert or think about what would tell me that this breakdown is actually playing out. My logical thought is not, let me bring up some other oscillators and see if they're also diverging. One divergence for me is enough. And then I kind of switch into validation or confirmation mode and think more about signs of trend, support and resistance levels, Fibonacci retracements, things that would help me, validate, okay, this thing is now breaking down just like the divergence would have suggested it might have doing. So I guess that's a long-winded way of saying, in my experience, you don't need a number of different ways to identify divergences. Once you've detected divergence in that indicator that you use most frequently, use other types of indicators to confirm, okay, if this divergence really plays out, then this is what's going to happen in price. What can I use to help confirm that bad thing is actually happening? That's how I would think about it instead. Next question. What fundamentals of a stock? Oh, no, hold on. Oh, no. Boy, I totally changed the order here by mistake. That's okay. This is a great one. What fundamentals of a stock do you look at before entering a long position? Yeah, this is something, I've spent many times thinking about this over the course of my career. And I will tell you, have spent time working for big money managers. I worked at Fidelity for almost 9 years. As a director of research, worked with a bunch of fundamental analysts and fundamentally oriented portfolio managers, helping them use technical analysis. But the discussion would often go to fundamental stories and themes and takeaways and valuations. And so a lot of, that part of my career was trying to connect what we were seeing in the charts versus what the fundamental analyst or investor was seeing with the company, looking at the financial statements and their earnings releases and meeting with company management, all that kind of stuff. And, it was interesting just seeing how we could relate those two. So for me, I rarely look at a balance sheet or income statement or cash flow statement anymore, right? I used to when I was trying to learn all the different things, just trying to understand how companies were making money and how we were valuing them, definitely did. But what I've learned is, once you kind of, at least in my experience, once you kind of know what you're looking for, you have one of two choices. Number one, you can continue to dig very deep into particular companies to find the right companies, really understand the company management, really understand all the details. That level of depth is something a lot of investors want to do. And if that's something that you want to do, I'm thinking of someone, like Tom Bowley, who I know and respect very, very well. He early in his career was an accountant, right? So, he really understands, financial statements and loves to dig into that detail still in some ways when he's analyzing a particular company. That is not my background. And I don't find a lot of joy going through, deep Excel spreadsheets modeling companies. So I would say either you decide that's something and you want to go deep, or you need to find tools and resources that will help you evaluate companies that is not so time intensive. And the way that I've learned to do that is by using quantitative models, or what they call alpha models. Three that I've used very, very often that I would suggest if you're looking for something like this. One would be Mark Chaikin's, call it the Chaikin Power Gauge, which really has some fundamental and some technical stuff all mixed together, but he does have some quantitative methodologies of analyzing that. You can go to Chaikin Analytics website to learn more about that. Or they actually have a plugin on the Stock Charts platform where you can access their model. Seeking Alpha is another platform that I use regularly. They have a great quantitative model where they look at valuations and earnings and income and things like that from a quantitative perspective. If you want to look at that, go to marketmisbehavior.com/seeking alpha, because I have an affiliate link that'll give you a little better deal than if you just go to their website. And then the third one would be Investors Business Daily, right? IBD. Go to investors.com. I'm a huge fan of their stock checkup, their composite score, all the ways that they grade companies based on William O'Neill's methodology of looking for the characteristics of winning stocks going back for decades and decades. So, I mean, you have a choice to make, right? Do you want to go deep into companies' financial statements, really understand the individual stories, and then invest based on, with that information available? That's not me. That might be you. And if so, I would say find some tools like Koifin that I use, to really dig into the financials more deeply. But what I found is, for me, as more of a technically oriented investor, I like validating stocks that I'm analyzing with a check on models like that, right? Or the characteristics of this company similar to the characteristics of other good companies that have done quite well. So the direct answer to your question is a long-winded diatribe there. Short answer is what I do is I look at, I'm basically looking at the ability of the company to grow earnings. So what I'm looking for is companies that score well based on earnings growth and things like that. I don't pay as much attention to valuations because I've found in good uptrends, valuations start giving very negative signals, and that just means the stock's going up a lot. So not super helpful. Much more helpful in bear markets when you're looking for things that are very undervalued. I think valuations are super helpful, but in bull markets, they're kind of just a drag, and they just tell you things are overvalued all the way up as we continue to go higher. So less important to me, but I am looking at things like earnings growth, and I think what like IBD does in terms of the ability of companies to grow earnings, what Seeking Alpha does in terms of earnings quality, those are factors that I think help kind of cut the corner in terms of really digging deep into a financial statement and get me generally close to where I want to be in terms of just making sure I'm not buying a good chart that's a horrible company, which can happen. So that's my I guess abbreviated answer to that. I don't know if that's the right answer for you. I mean, I think that, as investors, we have to find the right balance of inputs to use. For me, analyzing companies fundamentally is a huge time sink. And for me, I don't think it adds enough value in my process to justify all that time. Models are a much easier lift, makes it easy to scan using some of those tools. And that's where I found it to be super valuable. Next question. A few months ago, I asked for insights on Bridge Bio, ticker BBIO, when it was in the high $20 range, and you suggested a bullish outlook. Now that it's over $40, what's your take at this higher cost? I mean, I would be lying if I told you I remembered looking at this particular chart before. I'm glad that worked out, to be honest with you. This is probably back. You mentioned it was in the $20 range. So I don't know where that was. Maybe you mean like in the 20s back here. Perhaps, because here back in 2024, it's kind of trading in the mid 20s. But I could see, like a breakout above resistance. I could see getting constructive on a chart when that would happen. Now, obviously, it's had a series of bases that have resolved to the upside. So what's the take now? So in this environment, what's happened is a lot of charts look kind of like Bridge Bio in that they're in primary uptrends, and the moving averages are what we call in the proper order, right? So we have the price, and then the 21-day EMA, and then the 50-day moving average, and then the 200-day moving average. They're all sloping upwards. So my comment would be, and this is a great time to answer this question, because, if I'm bearish on the major markets, which on a tactical time frame, I'm a lot less optimistic after what I'm seeing today and this week, where you're seeing clear signs of distribution. But even if that's true, I would not just blindly sell a stock like this just because I'm bearish on the market, right? If that's the case, I'm not a fan of making a macro call and then aggressively changing positions based on that macro call. I'm much more of a fan of, here's my macro call. This gives me my overall kind of allocation and how aggressive I want to be. But if a good chart is a good chart, that still deserves a place in my portfolio. That's at the end of every episode I say, which I will say again today, it's always a good time to own good charts. Doesn't matter what else is happening. If a chart's still a good chart, you should own that good chart, in my opinion, right? That's what deserves a place in your portfolio. Good charts, despite what is happening in the world around you. What's happening in the world around you is still super important, because that tells you how much you should be allocating to ideas and how much you should be thinking about growing capital or defending your portfolio. But a good chart is a good chart in any environment. I would say Bridge Bio is still a good chart. What makes it a good chart? Well, we're making higher highs and higher lows. The momentum is strong, but not excessive. The relative strength is still very good. We're still above an upward sloping 21-day EMA. The 50 and 200-day moving averages are all sloping up. I would be concerned about a Bridge Bio when everything I just said is no longer true. all those bullish technical signs are still in place. I think this is a chart that's heading higher. One of those that I would say innocent until proven guilty. Let the chart tell you when it's not going up anymore. Oh, perfect transition to this next question. When a stock is pulling back, how do you tell whether it is just a temporary decline or it's something more ominous? And I'll tell you that I had so many versions. That was an actual question I received, but I received a number of different questions about different stocks. One I remember being asked about was Caterpillar. And there are a bunch of these. I mean, you guys have asked about a number of stocks like this that have had good runs. How do I differentiate a tactical pullback versus something more significant? This is an ongoing challenge. I mean, I would love to tell you there's a perfect way to do it. There isn't, right? And there's no perfect way. There are some times where you will sell a stock like this when it pulls back, and then it'll just resume right after you sold it. There are times when you don't sell it, and then it'll break down and just keep going. I would love to tell you this is an easy thing. I think this is a challenging question to face. Having said that, the technical analysis toolkit is really designed to try to help you do this. So what I just mentioned is a big part of that. I tend to think of it as this way. If a certain set of conditions are true, I wouldn't touch it. And for me, remaining above an upward sloping 21-day EMA for me is a don't touch it signal, right? As long as Caterpillar, which is down a bit today, just over 2%, as long as Caterpillar remains above an upward sloping 21-day exponential moving average, the chart just is not getting bad enough where I think it's worth doing anything but just holding it. If I own a position now, which I do not in my own portfolio. But if I did, that would give me confidence, right? And what I like about that approach, it's like a line in the sand approach, right? Like here's the level, and if this happens, then I need to revisit it. But if it doesn't happen, then I don't need to worry about it. I don't worry about it, right? Your process as an investor shouldn't be which position should I worry about, and let me frantically check them to see if they're still okay. It should be, all right, here's my plan. As long as this happens, the chart's still good. And if this other thing happens, then the chart might not be so good. So for me, the 21-day EMA is kind of that initial thing. So what happens if it does break the 21-day EMA? That's where we need to start making, I think, a more specific analysis to the chart. This is where things can be a little more nuanced. Breaking the 21-day EMA is a pretty good universal check for me that says, is it still a good chart or not? And if it breaks that, then we need to start analyzing it with a further suite of technical tools. This is where we look at momentum. This is where we look at the 50-day moving average. This is where we look at Fibonacci retracement, see what sort of pullback we're getting. This is where I might look at volume to see if the volume is still supportive or not. So I have sort of that initial signal that would say, all right, as long as we hold the 21-day EMA, anything is just a temporary decline and nothing more ominous. We break the 21-day exponential moving average, it might be more ominous. And now I need to go to like that next level down. It's kind of like in medicine where you have like an initial screen and okay, well, if we don't pass that test, all right, then we have to go deeper and say, all right, then it might be something more similar. We have to do a little more detail to sort of figure out what it is. That's how I would think of it. And that doesn't mean the 21-day exponential moving average might be perfect for you, but for me, it's ended up being a really helpful tool. So what would I do in practice, right? Depending on the chart, maybe I would take part of it off, right? Maybe I would take I would sell partial position if we break the 21-day EMA, and then I would set a stage. All right, I'm now like a third of the way out or half the way out. And if we do X, Y, Z, I would close the position completely. Like a way I might think of it, and again, not generalizing, but maybe we break the 21-day EMA, I close half the position. We break the 50-day moving average, I sell the remaining half, and that allows me to sort of just take half off. And if it's not as bad from there, then maybe I reinitiate at some point. But for me, it's not as much of a blanket statement beyond that point. I would really want to analyze the chart in particular and look at price, moving averages, momentum, relative strength, volume, and then make a more comprehensive picture and then determine whether I'd still want to hold it or not. That's kind of how I would do it. Last question, where can I find good learning resources, either online or in print, of the intricacies of bar charts? Have not been able to find info to dive deep into the subject. Yeah, you had shared some further comments in a YouTube comment about this, looking and hadn't really found some good resources on YouTube covering bar charts. Candle charts are way more widely followed. I think just because visually they're more interesting. They have cool names that tend to capture people's attention, right? I mean, you've got abandoned baby candles and gravestone dojis and bullish engulfing pattern, kind of cool names for it. Bar charts are pretty boring. They don't have those names. But are they still super valuable? 100% yes. And for me, bar charts are kind of my go-to. And the only reason why I don't use candle charts more often, it's just when you're looking at this much data, the difference between that chart and this chart, like it's just not enough for me to really want to do it. But I have this candle chart ready to go, and I bring it up often. When I'm bringing up a stock, I'll bring up the candle chart and say, all right, any candle patterns I need to be aware of that might help me better understand what I'm seeing on this chart right now after my initial look. But I would say bar charts for me have been super helpful. It's just the way that I look at things. In the chart room at Fidelity, we didn't use really any candle charts. It was all bar charts. That's going back through the history of the group. And so that's probably part of what motivated me to kind of to stick to this. So what resources can I recommend to you? A couple different things, and they're more books. I mean, I think for me, it's going to books. I don't know any online resources that really treat these particularly well. But if you go to marketmisbehavior.com, click on reading list, I'll point you the two that I would go to. One, and it's right here, in technical analysis tools and techniques. These are the first two books I think I ever read about technical analysis, and that's where I would start. The one I would start with, Technical Analysis of Stock Trends by Robert Edwards and John McGee. This was written in the mid 20th century. It's gone through a number of different revisions over the years. I think it's on the 12th edition now. I want to say, I forget, 11th or 12th, but this is called the Bible of Technical Analysis. The examples are all incredibly outdated. The charts do not look particularly, visually great because they're like, photocopied back in the day. But the analysis is still incredibly relevant in 2025, I promise you. And that discussion of just bar charts and analyzing supply and demand by looking at price bars and thinking about what they mean, I probably learned the most from that book. Second book, similar in terms of its general idea, but more updated version, is John Murphy's classic book, Technical Analysis of the Financial Markets. That was actually the first book I ever read about technical analysis. I was completely hooked. It's a little less detailed. It's a little more of a kind of overview of a lot of different technical analysis tools and techniques. But its discussion of bar charts, I think, is one of the best at just explaining the basics of it and how to think about it. Those are the two books I would do. Again, you can get to both of those at marketmisbehavior.com/reading list. While you're there, a bunch of other really good books to help you improve your life as an investor. Get inside your head a bit and think about what happens between your ears as you make decisions, with things about psychology, behavioral finance, and a bunch of other stuff as well. So I hope you find that a helpful resource as you build out your library as an investor. We'll say thank you so much. We'll wrap it up for the day here. Thank you so much for all of those questions. Those came from people like you over the last week, just asking questions during our live stream or asking questions during the replay on our YouTube channel. All questions are welcome. I appreciate so much you guys sharing what you're running into as you're trying to apply what we talk about and analyze the markets. And again, if you want to take that next step and get some more hands-on help improving your decision-making as a behavioral investor, as a mindful investor, you can get more information on our premium memberships at marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out for 30% off your first 12 months on any plan. Have a fantastic weekend. Enjoy it. We'll be back on Monday, August 4th with our next episode. In the meantime, remember, it's always a good time to own good charts. Have a